Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. As a member of the Chamber Pension Plan, depending on your age, you are invested in one of our 6 life cycle funds, each with a different investment allocation and level of risk. But did you know you have the option of choosing a different fund than what you were originally enrolled in? If you are looking for less risk, simply advise your employer to reallocate your contributions. Remember that pensions are for the long term, designed to maximize your retirement funds. If you have any questions with regards to the fund you are currently in or why you might want to change, please contact us at 745-7630 or admin@pensions.ky. The Chamber Pension Plan. We're here for you.
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry, and I have the distinct pleasure of welcoming Richard Maparura to the show. Richard is a senior portfolio manager at Butterfield Bank and also has the distinction of being the current CFA Society Cayman Islands president. Richard, welcome to Money Sense.
Thank you, Simon. Thank you for having me.
My pleasure. Now, Richard, you are, I think it's best well described, a frequent writer on economic and finance topics in the local press.
Yeah.
And one of your recent articles that I took the time to read was around central bank actions and inactions. And today's show is going to be precisely about that. Is inflation a threat? Have central banks acted too soon? Have they acted too late? Have they acted with the wrong policies? But before we get into the minutiae and the detail of what central banks are doing, what actions are happening and what the problems are, perhaps let's just set the scene as to where inflation is. Is it a problem? What's the historical context for that and interest rates? So perhaps just help us out at setting that scene.
Yeah, no, thanks, Simon. And I think inflation is a big problem for sure. But fortunately, yesterday we got some statistics on inflation, and it seems to be slowing down a little bit, which was good news. Also confirmed by the stock market, with the S&P moving up, 2% up on that day. Inflation right now in the US is at 8.5% year on year. Last month it was 9.1%. So that was the excitement that came through. Essentially, inflation is a problem, which is something that we can discuss further. But this is where inflation is. And in terms of interest rates, which is essentially the federal funds rate from the central banks, especially in the US, we all know that during COVID, these rates came to almost nothing, zero. They have moved up almost 225 basis points up. So now we are in a range of 2.25 to 2.50 in terms of interest rates.
Now, you say that inflation has moderated a bit, 8.5%. That's still a high number, isn't it?
Indeed, yes.
It's been, goodness me, let's go a few decades probably since we were remotely close to something like that. So when we talk about things have got a little bit better, we're still saying they're extremely unusual in the context of history. Is that right?
That's very true. That's very true. And to put it to context, I think we should say actually 4 decades. So we're speaking about the last time the US has seen these numbers of inflation.
So that's the 1980s, 1970s?
In the 70s,
okay.
Yes. The period of the 70s and the 80s, this is when we saw inflation in the teens in the US. Okay. So over the period of 40 years, the US hasn't really seen something like this.
Which in and of itself is symptomatic of there must be a problem.
There is a big problem. That's very true.
Now, in the 1970s, a lot of historically now, when we look back at it, we can understand what happened. I mean, when you're there in the time, lots of mistakes were made and lots of uncertainties existed. But it was kind of obvious with the benefit of history to say, well, there was this supply side shock. There was this lack of oil that was causing oil prices to go up. It was causing this supply issue, which caused disruption around the world.
Mm-hmm.
Do we understand what the issue is today in terms of causing inflation? Is it as obvious? Obviously, we don't have the benefit of history and the benefit of hindsight yet.
Yes.
Is it obvious yet what what the predominant causes of inflation are today?
No, yeah, I think the issues right now they're a bit apparent, and you probably touched some of them. So we all know about the Russia-Ukraine situation. That has been a big problem, especially in terms of just the oil and gas space, and obviously the contribution of oil and gas into the dynamics of pricing is quite significant. We also have China. China has been a bit of a problem because of its zero COVID policy. So essentially China being a hub in the global markets, having them shutting down almost, all the outlets that we have in China essentially has caused supply chain problems, and that in itself has caused prices to rise. And those things, I think China, the Russia situation, and also the fact that we're coming out of COVID and there was a pent-up demand from people just wanting to spend. People wanted to travel, people wanted to just do outdoor activities. Those things have just driven demand and also constrained supply from China perspective, and the increase in oil from a Russia perspective. Those three elements have really caused the problem that we have right now.
So you're being potentially quite charitable then by saying that to central banks, because one of the thrusts of your article that I read was that central banks previously made a mistake, but you're very kindly saying, though the excuses for inflation are oil prices, are COVID related,
yes,
Ukraine, Russia, China, but you haven't said, well, one of the causes of inflation is central banks. Are you going to come to that, or am I putting words in your mouth?
Yeah, no, I think one of the problems that we probably cited in that article, which was central banks essentially, when this whole thing started, they were looking at inflation and they were arguing that it was transitory. I think that was one big mistake that central banks made, right? Not to admit that this thing is entrenched and they needed to act way ahead of time. So they delayed. And now the error which might happen is that now they're trying to fight it at an expedited pace. So now we see obviously what central banks are doing, particularly in the US, where we are seeing a sharp increase in rates within a short period of time. We have never seen a 75 basis points increase in such a long time, if time immemorial, I think, in the US. So these actions are almost conflicting, coming from the same source, right? The same source that said everything was transitory is now trying to fight the same beast.
And so I guess the argument that comes from that is the central banks will say, well, we made the mistake. We now realize it wasn't transitory.
Yes.
And so they're saying we now need to do something about it. And what you're saying is, actually, if they had acted sooner, this problem that they now realize wasn't transitory could well have been transitory. They could have actually created what they thought it was going to be. They could have actually engendered that sort of outcome.
Yeah, so that's one perspective, which is quite interesting. And to exonerate them now, in a way, as you see that oil is kind of coming down a little bit. So, and obviously some of the things that we saw just booming up, like grain and all these costs going up, they're coming down a little bit. So their argument of transitory is, in a way, shaping up. So they could say, you know what, we were not that wrong, right? But to a point again, in terms of how they also probably contributed into inflation, obviously, they have the instruments of cutting down rates, which went everything to zero, made borrowing so cheap. So essentially, they made money cheap to everybody. We also saw the balance sheet of the central bank, especially in the US, moving from a range of $4.5 trillion to almost $9 trillion. And what was the Reserve Bank doing? Essentially, the central bank was essentially buying bonds, right? So they were churning a lot of money into the market. So essentially those things, of course, they did contribute as well to inflation. Obviously, that's central bank, but we also had the government contributing as well, because they were giving people money while they were doing nothing. So people accumulated a lot of savings. In the US alone, we had about $2.5 trillion in balance sheet for personal consumption. That is just savings, right? So those things essentially contributed as well, much largely, to the inflation problem.
I guess an analogy trying to humanize it for the Cayman Islands might be, because in the Cayman Islands we don't have a lot of government action from a fiscal perspective,
right?
But there was the equivalent, in a sense, of the large amount of withdrawals that went from the pension system, which then went into the economy, and then anyone who was trying to buy a car was finding it very, very difficult,
yes,
because almost everybody bought a new car, it seems, and
those,
so the creation, or the distribution of money into the economy caused people to go and spend it, which then pushed up prices and made things very scarce.
Indeed, exactly. Now you're right, completely. I mean, you would have noticed that there was a tick up in the real estate market in Cayman, because everybody was thinking, if I withdraw my pension, what's the best thing I could do? Probably buying a car wasn't a good idea. So people decided to at least invest in real estate, and we saw a tick up, and that's essentially that. Too much money chasing few goods.
I actually tried to buy a car, and 3 garages failed to actually be able to sell me one.
Oh,
Walked in there and said, I'll buy one today, and they, each of them, I won't name them on air, but they all failed to actually deliver upon it. I'm still angry, still a little bit bitter. But if I can go back, though, a little bit further in history.
Right.
We've talked about the impact of central banks today, but a lot of the history, or the recent history, of interest rates and central bank actions has stemmed from still probably 10 or so years ago. We still had the financial crisis, and we had lots of things like that followed that. But interest rates have been very, very low.
That's right.
For an awful long period of time. Yes. And there has been this quantitative easing for quite some time as well. This all started long before COVID became anything. And it was never cut off. It continued to happen. So interest rates remained low. The central bank continued to buy bonds and such like, despite what was, before COVID, relatively speaking, a booming economy. Do you think that was part of the mistake that they made, or was that necessary? In other words, should they have started to withdraw some of that stimulus much earlier than they actually did?
In a way, I would agree, yes. But I mean, we can take a lot of notes from the 1970s period, right? So we want to talk about the Paul Volcker period, what he was doing when everything was almost exactly what we have right now. Back in that time, there was high inflation, oil prices were going up. It's funny enough, there was also a Russia issue because there was Afghanistan there, and the Fed was tightening as well. But in that time, I think the reaction from the central banks essentially made a testament that most of the times in history in the US, the central banks have not been able to play around with their instruments to manage, especially inflation, and without causing a recession in the economy, essentially, because they have to balance between price and also employment. But I agree with you to the point that I think they had good time. We had almost 20 years of time. And this is where investing in fixed income became essentially nothing, because a no-brainer, because rates were just coming down almost on a spiral. So I agree that I think they probably could have used that opportunity to start to increase rates without, this whole problem of COVID and now where we are today.
One of the classical points that's made in economics courses is that the time it takes for interest rate actions, so Fed putting up interest rates today, it takes time for that to feed through into the real economy, because people have a mortgage, but their mortgage might be fixed for 12 months, and therefore the ratcheting up doesn't take effect for longer.
Yes.
Is that part of the argument that you're making, to say, well, if you wanted to slow down the economy or slow inflation today, you needed to have acted 12, 18 months ago in order to get ahead of that game? Is that part of what you're saying?
It is true. And I think that economic understanding is very correct. The only problem we have these days is that we have the economy and we have the stock market. The stock market is very forward-looking and it reacts on the day. So if the Fed announces something today, you see a lot of movement in the stock market, and people get confused to think that everything has moved. But you're right that there is a lag in effects in some of the things, especially in the economy. So when you look at your mortgage, for instance, you're arguing that it could be fixed for the next 12 months. So even if rates are increased, it might not entrench. But when people see the reaction of the stock market, which is way forward looking, they always get confused that, everything has reacted. But you're right, yes. So they need time to play out. So whatever they're doing now, obviously the effects will not be felt immediately. But we get confused a little bit when we see the reaction in the stock market and we think everything has been affected immediately.
I guess, and that's obviously the case, say, in the US and probably in some parts of continental Europe. Probably, if we take this back to Cayman, a lot of people, though, in Cayman are probably going to suffer more quickly because of our rising interest rates than in other countries, because a lot of our debt is on floating rate terms, isn't it? So
yes.
Cayman's reaction to rising interest rates is probably more pronounced in that sense than you might find in other economies. So we could be more quickly impacted by something like that.
Yes, that's correct. So some of the things are instant, right? So because, for instance, in Cayman, the prime rate is obviously pegged according to the US rate. So as soon as you get an announcement from the US, the next day you're going to see newspaper flooded with all the banks announcing we have increased rates. So our prime rate right now is 5.5 in Cayman, which is obviously being driven by the activities of the central bank. Next month or in September, when we get a 75 basis points or 50 basis points, we're going to feel this the next day. So there are some elements of the economy that can actually be sensitive on the day, but some of them are entrenched and they need time to play out.
I think we're going to take a short break in a moment, but perhaps before we do, you mentioned about stock markets movement. The most recent inflation rate yesterday was followed by and you mentioned this, a quite strong movement in the stock market, up 2% or so.
Yeah.
And to your forward-looking point, it sort of implies that the stock market being forward-looking is quite comfortable where we are now.
Yeah.
Do you think there's some sort of mistake, or is that more accurate? What's your view?
Yeah, that's going to be interesting. I think I cannot speak for the bigger brains, but we have had about 2 Fed presidents come out just after the announcement of the inflation numbers, and they've already reinstated that, look, this number don't mean anything. We are going to continue to focus on inflation because it's still very high, 8%. Their target is 2%. So the market could be making a mistake. But what the market was trying to do there was emphasizing the fact that if inflation is slowing down, we expect that the Fed is not going to be too strong on rates. So the Fed might take a lower pace, or they might become a little bit dovish, right, so that they won't increase rates as faster. You know, the discounting mechanism in the markets when rates are going too high too quickly. So that's what the market was doing. The market was saying maybe this number will satisfy the Fed that they will not move too aggressively. But that could be wrong.
And as you say, a couple of Fed presidents have gone out and say, that was one number.
Exactly.
Doesn't mean a lot to us.
It doesn't mean much. And I mean, if you look in the numbers closely, the core CPI really didn't move from last month to this month, 5.9, 5.9, and that's the number that they target. And their expectation is to bring down that number to 2%. So you can almost see that they probably still want to use the same ammunition that they've been using to fight this same number because it hasn't flinched much. But it is, obviously, sometimes market reacts in a different way. But that was the interpretation from the market.
Fair enough. I think, just let me check with we can take a break. So we'll take a break right now and we'll continue this conversation straight after. Thank you, Richard.
Thank you.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. The current pension holiday is set to expire September 30th. Employers and employees will be required to recommence the legally specified pension contributions effective with October earnings. If you have any questions or concerns, please visit our website at chamberpension.ky or contact us at admin@pensions.ky. The Chamber Pension Plan, representing large and small employers in all sectors of Cayman's economy. Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Welcome back to Money Sense and our conversation with Richard Maparura, Senior Portfolio Manager at Butterfield Bank. Before the break, we were talking about central bank actions, we were talking about inflation, talking about interest rates. And Richard, one of the postulations you made in an article that you wrote recently was that one central bank mistake has then led to a second central bank mistake. What is that central bank mistake that's happening now, and what, in your view, then, are the consequences of that mistake? How should we be nervous? Should we be worried about the implications? Talk to us about that.
Yeah. So I think to make that a little bit clearer, is first point will be the first mistake is to acknowledge that there is inflation and it's entrenched. And then the second problem is to overreact when you then accept that there is a problem, right? So the problem with the history in the U.S. is that the central bank, since its inception in 1913, has never been able to reduce inflation by 2% without forcing the economy into a recession.
So, hang on, just let me get that right. That's quite a material point. They've never been able to reduce inflation by 2%.
Yes.
And we're currently about 8.
Yeah, but that's not the inflation they look at. So we are currently about 5 or 6.
But it still needs to go down by about 3.
Yes,
3 or
exactly.
4.
Yes.
So you're saying they've never been able to reduce it by 2%. It needs to go down by 4 without causing a recession. Carry on. No, you got me in a nervous mood. Carry on.
But that's essentially where the problem is likely going to be, right? So it's almost like they are now being reactionary. But how do they handle that? History has said they have never been able to do that. Mm-hmm. So that's where the error point is coming, that they failed to acknowledge acknowledge inflation ahead of time, and now they are reacting. And then we have seen in the history and past that they have never been able to control 2% of inflation without causing a recession. And that's the fear now, that's the error that the central bank might make to force the economy into inflation, into a recession. Sorry.
How worried are you about them making that mistake? How worried are you about them repeating the mistake of history of generating a recession then?
Interestingly, to be honest, right now the dynamics of the economy in the US, they seem to be very different from all what we have seen in history. So it's a good statistic that we have that they have never been able. But right now, if you look at the US economy, and I think it fits into employment, if you look at the US economy, the job market is quite strong at the moment. And obviously, we are seeing what is happening on the inflation front, and we are thinking, if you take a read from yesterday, we are thinking inflation maybe, getting to a point where it's coming down in a way. It's a little different now. They could be a case that the Fed could be right in a way that they might actually get what they are calling a soft landing, essentially balancing between inflation and unemployment. Right now, unemployment is at 50-year low, 3.5%. They are okay to have unemployment move a little bit up in a range which does not really cause inflation, which is close to 4%, right? But they also want to bring inflation down. So the dynamics are a little bit different. Going by history, they could be headed for a mistake that they cannot do it, but the dynamics are a little bit different.
There's an anecdotal point here, which I think anyone who's traveled to the US in the last 12 months, or frankly, any country in the world, it seems like, it's very difficult to find any restaurant, any hotel, any bar, any shop that doesn't have a sign saying staff wanted.
Yes.
So when you're in an environment where every shop, every restaurant, every hotel is looking for people to work, it seems extraordinary in a sense to be talking about the possibility of a recession. There's obviously, I don't know what happened in COVID, but clearly 5 million people just disappeared because they're no longer working.
Right.
But in that sort of scenario, it does seem incredible that we can even be on the precipice of talking about a recession, not about having one. Recessions are typically periods of unhappiness. People are losing jobs. People are unemployed, and yet there's thousands and thousands of job openings. So how do we square that circle?
You bring up a good point, Simon. If you think about the first definition of a recession, essentially is 2 consecutive quarters of negative GDP, which actually the US has ticked that box, right? So
that's the economist definition.
That's the economist definition, right? So we still and we still need to get to the granular definition of a recession, and it has to be announced that it was a recession in the US. And right now it's not. And you're right in terms of the employment side of things. That's why it's a vicious circle at the moment. I think COVID is playing a lot into all these dynamics, right? So if you think about the job numbers right now, last time we got about 500,000 people jobs added in the US, and the drivers essentially are almost all these leisure, hospitality, all these sectors which were essentially affected by COVID. I was in the US a few weeks ago, and you're right. Every door sign of a restaurant, any place, we are hiring. But there's also a flip side of things when if you start to look at obviously the dynamics of the hardships. If rates are going up, borrowing costs are going to go up. We have spoken about mortgages for individuals. All these things play out into the consumption of the individuals, right? Consumption is a big contributor to the GDP, over 70%. So if consumption starts being affected, obviously we're going to see a slowdown. If people start slowing down on spending, there was a statistic that said about 48% people voted that the first thing they're going to cut on is dining out. Okay, if that happens, obviously jobs are probably going to start to be lost. We have seen tech companies right now, over 30,000 employees have been laid off. Big companies are laying off strategies, Tesla, Netflix. Obviously, some of the Robinhood companies, they have different problems, right? Coinbase, different problems. But we are seeing that coming through from the tech side. But we are also seeing, and I think this is all because of COVID. The dynamics of COVID has caused a little bit of a sort of like a disorder in the job market. We have areas which still need people, like the leisure space, the hospitality space, but we have these tech companies almost making a forward looking and saying, look, because of where things are going, we probably don't need too many people.
One of the things that I pulled out of your article that you mentioned was the word cautiously. So I think you wrote investors should be positioned quite cautiously, given the circumstance that we're finding ourselves in. And you've talked quite a lot here about the levels of disorder that exist in terms of the economy. So it's quite a difficult time to forecast what's going to happen.
Yeah.
What does cautiously mean in an investment viewpoint? How should people interpret that? What's your interpretation of that?
Yeah. So I think the starting point for that is to just a simple analogy is that equities do well, especially when just looking at the market. Equities do well when there is growth in the market. Equities don't do that.
You mean
well.
Economic growth?
Economic growth, yeah. Exactly, right. Equities do well if they struggle, if there is below trend growth, and they actually do badly when obviously we're getting negative in terms of economic growth. When I said cautiously, essentially is an asset allocation question to investors. Obviously, you want to dial down risk, and how do you do that? You want probably to minimize your exposure to equities and probably increase your exposure to government bonds like treasuries in the US. Right now, the 2-year treasury is almost paying, a yield of over 3%. That's a good price that you can lock in and then just get that. So I think from an equity side, if someone wanted to be cautious, you want to be a little bit more defensive. If we are to get a recession, you want to be more defensive. So you want to be in sectors that are a little bit more defensive, like healthcare sectors, utilities, staples. So the word caution there was just on how you can structure your portfolio in the sense that we might actually get an error from the central banks pushing the economy into a recession. How do you want to be positioned? And that was the perspective.
I think one of the big challenges that a lot of investors face right now is they listen to what you say there about being cautious, and that rings so true with them.
Right.
But then they look and go, well, inflation's 8%. So if I stick my money in cash, which is historically the most cautious thing,
yes,
or even if I stick my money in this 3% treasury, I'm still 5% worse off each year. So
yes,
that doesn't seem very cautious at all. I know I'm going to lose money. So how do we reconcile that issue? Because it's a real one that inflation is real. We go to the supermarket each week, and the milk seems to cost an extra $1 every single week.
It is.
Whatever it is seems to cost an extra $1 every week. So sitting in cash is quite dangerous as well, isn't it?
It is. I agree with you. It becomes a very huge dilemma, actually. I mean, riding came and bringing it home. I used to fill my tank with $60. Now I fill it with $90. That's just a 50% increase. If my income does not increase, essentially it means that I'm taking that out of either some of my spending, right? And I agree. When it comes to cash, when it comes to fixed income, when it comes to inflation, there is a big problem there. And that's why, obviously, when you look at an asset allocation, you want to have at least a certain portion of your assets invested in an asset class that can track more closely inflation, and that's your equity. So we are not saying 100% move away from equities, but we are saying be cautious in your allocation between asset classes and also within asset classes.
So sectors within.
You
don't need to be courageous and do the brave thing of investing in the high risk equities. You can invest in the more cautious equities, is what I'm hearing from you.
Exactly. Knowing exactly what is happening right now, seeing there's a phrase that always say, don't fight the Fed, right? So if the Fed is increasing rates, we've seen what has happened, especially in the technology space. It's just the discounting mechanism. A higher discounting rate for future cash flows is just going to mess up everything. And that's what we are saying when we are saying be cautious. So you better pick a bucket which you think will work well in the current environment. And interest rates are going up. You don't want probably to expose yourself to high duration, sectors of the market. So you want to be a little bit more on the cautious side. And that's the allocation that you can do specifically in the equities space.
I think I've been hosting this show for about 4 years, and I've always managed to end on a rather pessimistic note. I'm not this time. Richard, you're going to help me here in the last 30 seconds. Am I right in saying there is a potential light at the end of this tunnel, in the sense that, and I think you touched on it, oil prices as an example, you talked about your car and the cost of filling it up.
Yes.
The cost of the electricity that we buy from the utility here. There is a possibility that could be coming down. Because global markets for energy prices have also fallen, haven't they? So
that's true.
Tell us something positive. Go on.
Yeah, I mean, certainly it's good to note that oil has obviously come down. We just hope it stays there. We don't know what will happen in the Russia and Ukraine situation. China is somewhat, trying to open up a little bit. So all those things are quite positive, and those things should trickle in. And we have seen already how they've trickled in the inflation number. Hopefully they continue, and it can come down to the individual, and probably I'll pay less for my tank.
I think that's right. I think Cayman typically sort of buys its oil with a 2 to 3 month lag from where the market is. So
yes.
3 months ago the oil price was around $120 a barrel, and today it's 90.
Yes.
So that's a substantial decline, which one hopes might trickle down through to potentially lower electricity bills and lower cost of fueling your car. Richard, as is always the case on Money Sense, our time is limited and we are very close to our limit. So thank you very much for joining. It's been an absolute pleasure having you and the discussion we've had with you. Thank you very much.
Thank you, Simon. Thank you for having me.
My pleasure. A couple of quick notes before we depart. The CFA Society Cayman Islands is finally, once again, COVID now over, rehosting its annual investment forum. Stay tuned to this show as we will be giving out discount codes for people to register. That's taking place at the end of October, and it promises to be an incredibly interesting conference. It's all about artificial intelligence and technology and what it means for the future of investing and, frankly, humanity. The final note before we leave is just a thank you for tuning in, and remind you that this show will be available on YouTube and also on the CFA Society Cayman Islands webpage. If you have any questions or topics, do email us at candw.ky or tweet us at Money Sense Radio. With that, thank you for tuning in, and please do join us again in 2 weeks' time.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit Chamber Pension.